Good evening, everyone. Welcome to our Fireside chat with Atul Kapur, co-founder and chief investment officer, Everstone Group, the largest PE firm that does investments across India and Southeast Asia. Having seen the rise of private equity in India over the last decade, Atul Kapur will take us through the onward journey of this asset class in the post-pandemic world. How will Everstone, best known for its platform, value-added strategy, as well as its buyout approach, navigate its operations across PE, VC, real estate, and infrastructure? That's what we're going to be discussing today. Atul, welcome, and we're delighted to have you join us again.
Thank you, Joji. I'm honored to be on your program. So let's go.
Yeah. So let's get started. So I'm going to start with a big picture question, because ultimately for a PE business, what defines a business is exits. So Everstone, you've been riding on a slew of exits over the last, from 2020 and 2021. There's Modern Foods, there's Everrise, there's Burger King India, there's Action Pharmacy, so OmniActive. What's the common thread here?
I think the common thread, Joji, is the fact that what defines a private equity firm is returns to investors. And India, unfortunately, for the longest period of time, had an unfortunate track record of not returning capital to investors. People, in a humorous vein, used to call it Hotel California, where you can check out when you want, but you can never leave. And I think what we decided about 6 years ago was that in order for you to drive exits and return of capital, return on capital and return off capital to your investors, you needed to think of exits almost as hard as you thought about of your investments. So we started weaving in our exit thesis into our investment thesis, which is, it was not good enough for us to say, or the deal teams to say, that this is a great company and there will be a buyer for this company. We needed to have a line of sight as to who the potential buyer of this business would be. How would you have to market this business halfway through your journey in order for you to attract a buyer? What shape and size the company needed it to be in order for you to attract either a trade buyer, a public market exit, or a private equity exit, and we've done all. And therefore, what happens is we laid down the journey. The roadmap from entry to exit is written down for each and every investment that we have. And we measure that in time, because for us, a 48-month hold period is the optimal hold period for any investment. Of course, we'll hold assets longer as we do, either for the right reasons or the wrong reasons. When things are not working out, you need more time to get companies fixed, or when things are working out fabulously, you get a little greedy and you want to make more multiples and more IRR just because the business is on a roll. So we've got both ends of the spectrum are in our portfolio. But I'd say for 80% of the portfolio, we are very, very disciplined that we want to exit within a specified period of time. For us, we've defined 48 months, and therefore we map the journey in those 48 months in a very detailed manner. And so, just bringing focus onto your exits and writing and running that journey has got us to where we are.
Got it. So what's then the exit plan for your Indonesia food portfolios?
So, in Indonesia, we have two assets, Joji, as you know, Burger King in Indonesia and Domino's in Indonesia. Both through the pandemic have been performing actually reasonably well. And this is in the public domain, so I can mention this. Burger King in India, which is a listed company, has communicated both to the stock exchanges and with its shareholders that it is going to make a bid for Burger King Indonesia. So they will end up buying underneath that listed company, Burger King Indonesia, and therefore will provide an exit to both us and part exit to our partners in Indonesia. Domino's, we think we can still drive the business. We have roughly 170 stores in Domino's. We think we can still continue, and that has enough capital. We can still continue to drive the growth of that business. And through the pandemic, as you know, Domino's has transformed itself from a pizza company into a tech company. If you listen to what Domino's in the US has to say about itself. So we think we will continue to drive that business and then look to an exit, either to a sponsor or we'll find, or roll it up into a larger platform across Asia. So we haven't decided on that yet. But Burger King is on its way to getting acquired by Burger King India, subject to minority shareholder pool and everything else, because it's a related party transaction. So minority shareholders of Burger King India have to approve it, and we're hoping that we will get that approval.
Interesting. So let me just come to another big picture question. The IPO run in India, is it great companies or just the bull market? Or is it that many of the companies that are coming to the market now have a scarcity value?
Listen, I think it's a little bit of everything, Joji. You know, rising tides lift all boats, small ones, big ones, medium ones, right? So I think what you're seeing is excess liquidity in the market, very low interest rates, and the fact that in this cycle, people want to hear interesting stories. You're seeing massive digital disruption in traditional industries, and people are using their imaginations in terms of what these businesses could be and should be. So I think, unfortunately, at this stage of any bull market, the markets are slightly indiscriminating, so everything floats, as long as you have a sensible story, a good management team, and demonstrable numbers. And I suspect that, you know, if in a year and a half or two, as interest rates will rise as they inevitably do, and liquidity starts draining out of the markets, I think you will see a sifting of the markets where, you know, the not so great companies are not going to trade that well, and the great companies will trade. So that rotation away from everything into a flight to quality, I think we're still 2 years away from that.
Got it. Atul, when you started, you spoke about the PE scene in India being something like Hotel California, where you couldn't exit. But just related to that, you know, despite the pandemic, more PE funds are being raised in India. There's record dry powder in India, both from domestic firms as well as global firms looking at India. Deal numbers are up. Transactions are being completed really quickly. Some exits have been happening too. So what's really changed overall in India? Is it the exits coming through?
Yeah, I think, listen, there's a natural evolution of these markets, you know, where we started from 25 years ago, which was a predominantly a minority investment market in traditional industries, where if the company wobbled or the market shut down, you couldn't sell the company to a trade buyer because no promoter would want that. So from a minority investing perspective, and as the country went through a bunch of different crises, exits were poor. And so that, you know, what happens is that it takes 10 years for a fund to really mature, right? Door to door takes 5 years for exits, 5 years for investment, 5 years to exit. And therefore, when people look back at vintages, they say, you know, money has been stuck in India for a long time. So the 2000, 2003, 2006, 2010 vintages weren't fabulous. They were okay, and depending upon which manager you decided to back. So people who had more public market exposures and had liquidity, and people who did pipes, could manage to do well and return capital. People who had only a pure private strategy in minorities got stuck. So that defined, you know, what people's perceptions and thoughts were about India. Then as we've rolled into the last decades, you know, buyouts, you know, as something that we sort of led the pack on, are becoming more and more, you know, run of the mill. More people are getting into that, and therefore you can dictate the rhythm, the cadence, and the style of exit that you want to run. The second thing that's happened is that with the advent of the sort of technological boom and all the money being reallocated into technology-driven businesses, what's happening is that Series A, B, C, D, E, especially in businesses that are growing rapidly and demonstrating traction, the A's are exiting to B's and C's, B's are exiting to D's and E's. So what's happening is there is liquidity flowing in tech-driven scale-ups. So that is also changing people's perceptions that, you know, markets are rewarding you to go in early, and you're getting capital return. It's not just an NAV last round markup. So I think, you know, and it's listen, this is a signal of just market maturity. And, you know, I invested for Goldman Sachs in Europe in the late 90s and the early 2000s, and the same issue you saw in Europe. It was a minority investment market when I showed up in the late 90s. By the mid 2000s, the cycles had started turning. It was a buyout market, and it's a reasonably well-developed market with, you know, exits and, you know, reasonably liquid exits and stratified markets. I think, you know, if you think about your exit potential to another private equity firm, you need to have people to exit to. Because if I am running a business that I buy enterprise value 300 million, equity value 200 million, I want to make 3 times my money, I have to have someone who's going to buy that company for 600 million, especially if it's a buyout. So I need to have line of sight of that. And, you know, 5-10 years ago, there wasn't line of sight. But today, all the global funds are there. They are the recipients of businesses that I can grow and sell And then as they scale businesses, there are bigger funds that take those assets off their hands. So it's just a natural evolution that is happening in the markets, and I think it will continue. And exits will reinforce that whole cycle. I think we're the flywheel of the virtuous cycle, I think, has started. And I think for the next 10-15 years, India is going to be a great place to be investing in.
Yeah, thanks. Very interesting. And specifically to Everstone, what's the status of your fourth fund? Because you were in the market raising about 950 million, and when is the final close expected?
I think we should be done with that fund, Joji, by the end of summer next year. And we have reasonably good traction with our existing LP sets. We generate a lot of co-invests in our portfolio. So what we are also doing is taking our time to identify one or two large partners who we want to come in as LPs, who can stand with us when we write $200 to $300 million equity checks, because we would like to write at least 8 to 10% of the fund in a single investment, but we have the ability to generate significantly larger sums of money as co-invest. So we're going to take our time to find a good partner for us as an LP, but the existing LPs are, we're in pretty good shape with them from a re-up perspective. So summer of next year, I think we'll be done, but we are already in the market to close transactions. Our first close is almost done, and we are running. So, the treadmill never stops. So we have to keep deploying capital and exiting and deploying capital. So
and how much? Sorry. No, please go ahead. Sorry.
No, go ahead.
I want to know how much. You mentioned your first close was done. So how much was your first close at? And anything that you will do differently with this fund using all your past experience across all your previous funds?
So, if you look at Fund 3, Joji, we typically will layer in 12 companies in a portfolio because we think that's the optimal size for us. Anything more becomes too distracting, anything less becomes too concentrated. So within the 12 in the last fund, we had 1 minority investment and 11 controlled investments. And we had a significant minority in a company called OmniActive, which we sold to TA Associates. I think we will follow the same path that, 10 to 11 of the 12 investments that we will make in this in the next fund will be controlled, and we will relent on 1 or 2 where, especially in sectors where we can't access deals without being in the minority. And the reason for that is, like I said, is just that we want to drive exits on this cadence and rhythm that we have. And we, irrespective of what the cycles are. And, in the midst of the pandemic, we have managed to get exits done, which if I was in a minority situation other than OmniActive, which we also got done in the pandemic. So, full marks to my partner, Sanjay Mariwala there, who worked with us to get the exit done. But I just think that we have decided that's the way we will go. So there is no drift and change in strategy. We're just going to start scaling up the size of investments we make. We do a lot of cross-border investments between the US and Asia along the IT services and pharma and nutritious sectors, and we will continue to do that. So from Fund 3 to Fund 4, we don't see a lot of change.
Got it. I'm just going to come to the US the part of the business in a bit, but before that, just seeking a quick update on your other businesses, like status of your real estate and renewable energy funds.
So on the renewable energy side, we are just about to close out the fund by bringing in other investors. So the size of the fund there is a little over 700 million. I think it's 740 million to be exact, but it's in that zip code. That business has been investing in building platforms for now 2 years. The pandemic sort of threw the fundraising plans a little awry as the teams couldn't travel, but even that, as people got used to speaking with teams on Zoom and so on and so forth, we've got fabulous marquee investors in that, marquee large investors now in that strategy, and I think we are probably the single largest climate change fund this part of the world. I think we're the largest in any developing market. We're definitely the largest in India, and we are using the capital and our capability to develop multiple platforms, not just solar and wind, which has absorbed 90% of the capacity in terms of capital being allocated. We're pushing ahead in e-mobility, we're pushing ahead in waste and water. So we're taking a holistic view of climate as a whole. And so that business is helmed by a partner of mine, Dhanpal Chaveri. So that and has an independent team. So that business is running, and we're very happy with the evolution of that business. On the real estate side, as you know, we're a dominant player in industrial real estate in India, Joji. We have 65% of the market for A-grade industrial real estate in India. We have developed 25 million square feet of real estate. We're probably the third largest real estate developer in India, period. We put out 7 million square feet of real estate a year. With the existing funds, we have the capacity to develop up to 45 million square feet of real estate. As you know, we have a private REIT with CPPIB where we take stabilized assets and inject them into that vehicle. We will just continue to want to dominate that asset class. You know, it's very rare that you find a single entity having such a significant share of any asset class in the real estate world. So, we are in the process of raising our fourth fund in our real estate business and continuing our strategy of developing and dominating the markets.
Got it. And how much are you targeting for your fourth real estate fund?
I think we will look to be in excess of $1 billion there.
Got it. Thank you. Just coming back to your other business, the credit business. Just take us through what's happening there.
So we played credit, as you know, Joji, through Fund 2 and a little bit through Fund 3 in a business and a platform that we had started called IndoStar in 2010. And that business started with corporate credit and structured real estate credit. And we got enough pool of profitability and 4 or 5 years into that journey, we then started layering in the retail credit. As the world has moved on and, post the IL&FS crisis and other issues that India had in 2018-19, that business has pivoted now almost completely to retail. It's running down its corporate books. Brookfield is a large shareholder there. Now they own 50% of the company, as you probably know. So that business is going to concentrate only on corporate secured credit, or on non-corporate secured credit, so SME retail housing. So that's kind of where the destiny of IndoStar is. So what we have done is we have taken the team that worked with us to develop the corporate book out of IndoStar with full transparency and with our partners, and we are in the process of raising dedicated capital behind that corporate credit team, and we're hopeful that in the next few weeks we should be able to announce closure of a vehicle where we will pull down capital and start deploying capital in performing credit in India.
Got it. Okay. Just coming back to just want to take a couple of minutes to look at your broad strategy. I just wanted to start off with you have combined strategies. You also build a lot of businesses from zero, which is not a traditional PE play. Be it Burger King, and you just mentioned about IndoStar, several others. So it's almost like you're in a space which conglomerates do, starting businesses from zero.
That's true. And sometimes people ask us, are you a business house or are you a private equity fund? And I think we say, listen, we bring the approach of a business house in a fiduciary construct. We don't have not as much capital of our own, so we have to rely on third-party capital. But our approach is that, listen, if you look at the last 15 years and the evolution of the Forbes 50, the Forbes 100 in India, they're all entrepreneurs. There are very few private equity professionals who have grown and created wealth and created large businesses. So I think what we do is we bring an entrepreneurial mindset to deliver returns for our investors. Listen, when we started our industrial real estate business, there was nobody. We were the first institutional player to build that, because most real estate developers told us we were crazy. Who wants to hold assets forever? And why would you want to get into a capital intensive and capital heavy business? And roll forward 15 years, we built a great platform. The same issue is with climate change and renewables, that people were like, listen, why are you want to do anything other than solar and wind? Because we think there's an open space where we can build an e-mobility platform which in 10 years will have 15,000 vehicles in India that are in B2C and B2G contracts. So I think what we try and do is we try and marry capital with talent and technology and say, can we create long-dated enduring businesses, whether in a private equity construct or beneath them? And that's just the way we are. So we try and marry those, Joji. But having said that, I tell you, building platforms is a long-dated game and not necessarily well suited to the private equity construct. People want exits. You can't, we've owned Burger King now for 7 years, 8 years. We've owned IndoStar for 10 years, and it takes that much time to scale businesses up. So I think in Fund 3, we did no platforms, but we did roll-ups, and we've done them very successfully. So Ascent Farmeasy was a classic example where we rolled up 18 or 19 companies. In India and Southeast Asia, we've started a platform called Everlife, where we are buying businesses. We started with a $4 million EBITDA acquisition as our first one. This year, our EBITDA will be close to 30 million because we've grown these businesses organically, and we rolled up 9 different businesses. So roll-ups are a lot easier to do and then meet our criteria of rapid exits. But builds are long duration, and we haven't done any in Fund 3. But we bring the same mindset of how do you buy businesses, how do you integrate them, how do you grow them, how do you structure leadership, how do you need to be in a leadership position. So Ascent Farmeasy is the #1 online pharmaceutical business in India. Everlife, which is our medical device distribution business in India and Southeast Asia, is the largest of its kind in this part of the world. So we look to build businesses that have dominant sort of position in the market and have scale. And so that's the view, and that's the approach that we bring.
So what are the sectors or white spaces still left where you can start a business from scratch?
Very few, man. Very few. But listen, I think I say that in jest. I'll tell you what we think. We think that massive disruption is afoot, and whilst starting a business from scratch is a long-dated issue, I think riding the digital wave, if you can spot opportunities where you can apply your capital and your capabilities behind a sensible entrepreneur, of course, for us in a controlled situation, I think there are lots and lots of industries that are waiting to be disrupted. So can you disrupt manufacturing? No. But can you disrupt the way a manufacturer approaches its end markets and end customers better than its competitors using technology? Absolutely, yes. And so, what we are seeing is in a lot of D2C sectors, direct to consumer, you're seeing massive amounts of disruption. Traditional methods of distribution are all falling by the wayside. Of course, building a new age business takes a lot of capital, and I think we're beneficiaries of excess liquidity. And the question is, in 2 years' time, will this liquidity be around to enable these businesses to continue? But if you can find a category killer with a great management team and capitalize it correctly, which we did for Ascent Farmeasy, in 4 years, we bought that business when it had $35 million of revenues. 5 years later, it's got $1 billion of revenues. Now, if you think in a traditional mindset, traditional industry, you can't do that. You can't grow a business, 30 times. But today, I think the market and the environment affords you the opportunity to do so. So I think the way we are thinking has also changed in terms of where can disruption happen, and therefore in that sector, can you find a team that you could capitalize properly that can lead that disruption. So that's where we're focused a lot. I think listen, fintech, massive disruption is afoot, and you're going to see the next gen financial services businesses are not going to look like anything what traditional services businesses look like. Bajaj, take an example. It's a technology company. It is no longer a lender, and you see its market capitalization. It's more than State Bank of India, and I think that trend will continue. So if we think about things that are going to get disrupted on a global scale, financial services is #1.
Got it. Before I come to fintech and tech, just a quick another question on the people side. You're not a lean for like a PE firm. You have hundreds of employees with offices in Mumbai, Delhi, Bangalore, London, Singapore, New York, Mauritius. So how do you sort of measure return on all of these investments when I say investments, I meant in having such a large talent pool? And did that help you, especially during the pandemic when your portfolio companies needed support, that you had a huge bench strength who could come in and help?
Yes. So the answer is, how do I be measured return that I'm invested? For us, there's only one measure, Joji, and that measure is, what returns we generate for our investors. And I think, a long time ago, we had this silly line, that we were like Avis in the world of Hertz and Avis. We just work harder. And that was Avis's tagline. And so I think, the fact, it's not just the numbers that matter, because the real estate is a development world, and it takes a disproportionate number of the total employees that actually sit in the real estate world, relative to all the other strategies. But even then, I think we, man for dollar, I think we are probably way more than most of our peers. And I think what that does is specifically around our operational capabilities, because we have large operating teams that sit with us in all our strategies. I think their ability to grasp the issue, to parachute in, to really figure out what is going on. So we looked at, and the pandemic is a classic example. In April, we had no idea what we were going to do, because in terms of, it was the beginning. Because we were in Singapore, we caught it early. We forced our companies to start thinking about conservation of cash and how to manage your working capital, your credit lines, your manufacturing schedules, and so on and so forth. And as we worked through from April to December, a lot of our internal talent was focused on making sure that our and internal capabilities were focused on making sure that our companies navigated these challenging times appropriately. So, it's not just the sheer numbers, but it's the quality of people. But, I didn't have to rely purely on outsourced service providers to go to an E&Y or a Bain or McKinsey saying, help. I had my own people to say, this is what we are going to do. And now we will hire an advisor to do this specific task for us. So I think our capabilities really, came to the fore was probably the most testing times in our generation. So yes, I feel very, very good about the teams that we have. And yes, we spend more dollars than any other firm of our management fee on keeping our infrastructure alive, but we're hoping, and it's bearing fruits, that it will translate into better returns. I'm not sure, but we're not aiming for just better returns, Joji. We're aiming for more consistent returns. So I want cycle after cycle to deliver consistent returns, and that's good enough for me.
Got it. And your strategy for Southeast Asia, especially for a market like Indonesia?
So Indonesia, has been very good to us, I must say. We're in two sectors there. QSR, as you know, we own Burger King and Domino's, and both have been fabulous investments for us. And in our medical device distribution business, where we're also present in Indonesia, also we've had just a fabulous experience. I think for us, as we can't be private equity investment tourists. We can't jump in and out of Indonesia, sitting in Singapore or sitting in New York or sitting in Bombay. I think you need really local partners to do what you have to do. So what our strategy for Indonesia is focused along those two vectors. That we will do QSR because we know brands, we know food brands, and we know the industry, and we know globally what works. So that's something that if we do anything more there, it would be on that vector. And then healthcare, because we think that, especially now, as unfortunately the pandemic's, shown glaring gaps in most countries' healthcare infrastructure, we just think that if there's one sector that I'd like to bet on for the next 5 to 7 years in Indonesia, is healthcare, and both providing services and providing other products and services into that sector. I think it's going to be a big area of focus for us. But we need partners on the ground. We're blessed. We have fabulous partners in both the businesses that we own in Indonesia. And I think for us, that's the way to go. That it's unlikely we're going to wade into Indonesia just by ourselves. We will probably do this with partners.
Got it. Atul, we just have a couple of minutes left. So I just want to quickly move on to the tech part. Do you think you will change your approach over the years when you've spoken to Everstone, and you haven't really looked at, you mentioned fintech earlier, but you're not seen as an active tech investor because most of the tech deals are minority stakes. Do you see yourself doing some of these deals?
I think, so listen, we started with what we would, I never say no, Joji, but it's not part of our core strategy yet. And I re-emphasize yet. I think what we are going to do is you can't ignore the importance of technology in all businesses today. We whet our appetite with something like Ascent Farmisi, which, as you know, is going to be a great outcome for us. We are taking the learnings from there. And when we started that journey, we owned 65% of that business. And over a period of time, we have gone from a majority stake to a minority stake. So I think we have mapped a journey for ourselves that works for us. And I think you'll see us replicate that journey in such situations where we will start with a large stake, grow the business, continue to raise capital in that business if it is a category killer, and our exits, we will slowly wean away from being a majority player to a minority player and then exit and transition the business on to the next set of investors. You know, the founders of PharmEasy, relative to all the other investors, own a small stake, but they are the guys who are the passion and the fire, and they drive the outcome. So I think we figured out a formula that works for us. So in that formula, we will play.
Got it. In the beginning, you also spoke about cross-border deals and buying out businesses in the US. So I assume that these are in the like tech-enabled businesses, be it IT services, healthcare, pharma, whatever. So is that where you think you can leverage your strengths, where you can buy out businesses in any part of the world, while you're not India centric, you're sort of India focused, where you can leverage the back end and the IT skills and the sets that India brings in, and does that make you a differentiate, like give you a huge differentiation?
Listen, you know, over a period of time, you know, everybody can do this. This is not rocket science. You know, through our investing careers in different places that we've played those themes out. We just were early to the party. We decided to get physical presence in the US. Our operating partners in both pharma, in healthcare, and in IT services are based in the US. And we leveraged their capabilities and our physical presence in the US, and we started investing. Now, can any other player in this part of the world do it? Of course. It just, you know, there's nothing that stops any other of our peers to replicate our strategy. We were just off the block a little earlier. And I think we will continue to refine that. We will continue to figure out, go deeper into all sorts of other sectors within the broadly defined IT services and IT enabled services businesses. In pharma, we will pass through all sorts of other. So what it does is, I think, Joji, if you're first to a party and if you are successful, then that gives you the confidence to start looking at all sorts of adjacencies, because the world catches up in version 1.0. We want to be in version 2.0 when the world catches up with us, and our world, as we define, is sort of Asian manager. So I think the markets will keep on evolving. Others can do this. I don't think we have a unique mousetrap that lets us do it. We just want to be just slightly ahead of the game and continue to evolve. That's that simple strategy at the heart of it.
Got it. One quick question on, you have listed so many of your portfolio companies. Will you look at SPACs?
You know, so listen, SPACs are, they've definitely been the flavor of the last sort of year, but I think they're running into they're running into a little bit of a headwind, because the pipe market in the US for SPACs is challenging, and as a result of which there is more dry powder than there are targets. And in addition, you have the issue of the pipe market not functioning. So it's a wait and watch. And as you know, Singapore has just put out its own regulatory framework for SPACs, and they've asked us to take a look at that and see whether we'd be interested. I just think the ecosystem is yet untested, because there was a rush of liquidity into it. There's been a rush of liquidity out of it. So for us, it's a little bit of a wait and watch. We'll see how things pan out, and then we'll take it from there.
Yeah. One quick question on your VC play with Deepak and DSG. So Deepak joins us for one of the sessions over the next 2 days, and he's also raising his 4th VC fund. How was that relationship evolved?
So I've known Deepak's, I've been friends with him for, over 25 years. He used to be at Bain and Company when I first met him in Singapore in the late 90s, and then he went off to INSEAD, and then we met up again in the UK. He was working for Reuters Venture Capital. So we've been friends for long, and we've co-invested for a long period of time. So, Deepak for us is he's a fabulous artist. He really understands how to spot great entrepreneurs and back them with capital early on, and be their rock as they navigate, the shoals of early stage companies, the uncertainty and volatility of early stage companies. So and our job is to provide him with an ecosystem that he can plug and play into. In the consumer side, which is where he tends to excel, there is enough capability, operating capability, portfolio heft, that we can, cross-fertilize assets and ideas. And also, for themes, he's a great test bed. We love, we love the whole pet theme in Asia. We can't find anything to buy which is evolved and large enough for a control transaction, but he's exposed to pets in an early stage basis. So what it does is it gives us the flexibility to play emerging themes, and if it doesn't work in this pocket, we'll play it in this pocket. So it's been a fabulous partnership with him, and looking forward to many years of a great partnership.
Yeah, we've already exceeded the time. Thank you so much for joining us, Atul. Fabulous conversation, great insights. And it was a great pleasure to have you join us for our summit again this year.
Joji, always a pleasure. Thank you very much. And you have a fabulous summit based upon the roster of speakers, and wish you all the best.
Thank you.
Take care.
Thank you. Bye-bye.